Just a quick sound check. When you get a chance, thank you, Karel. All right, Charles. Hey, Raj. Hopefully everyone is doing well today. It is the Monday after Thanksgiving, the holiday, so we should see an increase in volatility. We should see trading just get back to normal until we head back into the Christmas and the holidays towards the end of the year. So what I want to do today, I'm going to show you some live trading as well. I also want to discuss a little bit on the January effect, which I want everyone to be prepared with once January rolls around. There's a lot of videos out there that I have over the prior years explaining how this method works, and you can definitely check it out and take what you can from it. I'm going to show you the Trade Scalper. I'll show you the Atlas line. So with the hour we have today, I want to give you as much information as possible. And if you have any questions after the presentation, feel free to email me, support@DayTradeToWin.com. All right. Now I do have a new mentorship class starting today. If you are interested, there's still room available. The classes are very small, which is good. So if you'd like to spend the next 8 weeks with me, just send me an email. I give you all the information. I want to make sure it's right for you as well. All right, so to begin, I have a couple of charts here. I have multiple monitors, but I'm going to focus before the Atlas line and before the Trade Scalper really start taking shape with the trades. I am going to begin today with this January effect. And the idea behind the January effect is how do the professional traders focus on the year ahead? And you could say that they have their own internal indicators and criteria, and it's true, but I think that for the most part, there is something that they go by, which allows them to be more biased to the long side or biased to the short side, and that's this January effect. And basically, what happens is the first month of the year, January, has to close higher than where it opened. As we begin into February, I want to see a clear upward direction. As we start the month, the market may actually go down. Wherever it happens to close in February 1st, we're going to see a delineation of the bias, and you're going to hear it in the news, you're going to hear it on the financial networks. But it's not just a buy and hold strategy, because a buy and hold strategy for us could be very dangerous. I can't hold a position for 100 or 200 points if it goes against me. But these traders, since they're managing other people's money, can. So I have a different take on how to approach this January effect. So for example, let's say here is January 1st, right here. And as we go forward here in time, the market may begin to go down and then start to go up and start to go up. And let's say here comes February 1st, February 2nd, and it's clear that the month has closed higher than where it opened. Okay? So as I begin to analyze, should I buy it, should I sell it, should I be an investor, should I be a day trader instead, if I just flat out bought February 1st or February 2nd, it's likely, or maybe potentially likely, that the market may turn around and give back some of these profits, or may start to channel and whipsaw. And that doesn't help us, because each day may bring maybe 20, 30, 10-point swings. Now, how do I know that? This is something that I want everyone to begin to use, if you haven't already, is you add, even on a daily chart, the ATR, the average true range. I like to use a setting of 4, which helps me understand that every day could move 10 to 11 points up or down. Now this ATR, as you see it, it's not constant, but it doesn't change that dramatically. So even though I can say, well, 10 points, I have a large enough account that I can hold it, that's really not the case, because we don't want to hold anything for 10 points. So instead, when the market retraces, so let's say it is a January effect, January is a higher close and open. For the new people who just entered the room, if you want to just give me a quick sound check and make sure that you're able to hear me, you're able to see my chart as well. Tamer and Jack. Okay, so, hey Tamer. So the idea now is to time it with the smallest potential loss. We don't want to lose big money. Well, if we have to take a trade, I know that there's risk involved, but I also want to make sure that before I just jump into a trade, that the minimal risk possible is how I'm approaching this. So even though the ATR may be just 10 or 11 points, nobody wants to hold that, right? And as a disclaimer, you know that trading is risky, so please do not trade with funds you can't afford to lose. Obviously, nobody wants to trade with rent money or mortgage money. If you have any questions, please contact your broker, okay, as well. So when you look at taking a position long or short, just remember that the market could very well go down as it could go up this amount. So this is a good prediction of what the market could do, and it'll always steer you in the right direction. Unless there's a big news event or some catastrophe in the world that happens, you're not going to see the market move much more than 10 to 11 points up or down. And this is a cycle, by the way. So we have markets that are slower periods, and this is probably the slowest you're going to see it. So here is a direct correlation. We're going to see the Atlas line shortly, Tamer. No worries. I'll show you the Atlas line. I'll show you the Trade Scalper. Okay. So not to worry. I'll definitely show you some examples. So as we move forward here in time, just remember that this being a cycle, this now is going to start increasing in volatility. And don't be surprised if you see the market before Christmas reach, let's say 25 points, 30 points on a daily basis. 25, 30 points. Yes, definitely, Tamer. I'll definitely show it to you live. 25 to 30 points, meaning from high to low. So you can't hold on to a losing trade for that amount of money. It'll destroy you. So we don't want that. We want to be able to time this correctly. So remember, first, add the ATR, realize what the volatility conditions are indicating. Right now, the market's slower, but I'm almost going to say with a 99% accuracy, this volatility will increase as we get into the end of the year, and then it'll get slower and it'll get more active. And if I just crunch up the chart, you can see that this is normal. So what we're looking at is price action being normal. We have volatile periods and we have slower periods, but it never stays volatile or it never stays highly under slower channel or choppy conditions for long. It definitely changes slowly day by day. So as I go here forward in time, what I want to do is I want to make sure that first we have some type of retracement. I would say minimum of 4 days. So 4 days, clearly the market is retracing. Now, I'm not suggesting it has to be lower lows or lower closes. I'm just saying the market has to give a significant move, something like this, or something like this. What you see here is not considered a significant move as a retracement. This is, and so is this, and so is this. But this is not. This is just a small little blip in a larger uptrend, okay? So I want to see a minimum, let me just write this down for everyone, 4 days at least for the market to retrace minimum 4, 5 or more. Now once the market retraces back, I can't say it's going to be an instant buy. So please don't just buy the market because the market's retracing. Let the price action prove that it's actually turning around and heading back up in this bullish bias to the upside. Now, there's 2 ways that I teach this. The first way that I like to do, which gets you in a little bit earlier, is once the market retraces back and begins to turn around and head higher, the likelihood of it testing the highs, or at least the attempt to test those highs, is very, very good. And if I know that, I can take advantage of going long as it attempts to test those highs. Remember, markets love to test where they've previously been. So that being said, if I want to go long, why not go long into an area that, first of all, the market has already traded, and second of all, we're heading back up to test these highs. So I like to use this Fibonacci tool, not for the Fibonacci numbers, but just to use it as the 50% value. The way you activate this is once you either choose the F8 shortcut, which I like to use the shortcuts, or the drawing tool here in NinjaTrader, if NinjaTrader is what you're using, double click on the actual drawing tool and change the values to just the 0, the 100, and the 50. And I like to keep this defaulted. Right click in this gray area, manage templates. The word default comes up, just save it over the word default. And that way, whatever changes you make are now going to remember and going to be the values to use moving forward in time. So if the market begins to retrace back immediately, what I like to do is wait until it begins to turn around, and once it breaks the 50% value of it heading back up to the highs, that's where I like to go long. Now, a good target would be 1 times the ATR. So whether that's 10 points or 20 points or 30 points, typically the market will move equal to the 1 times the ATR value. So you don't have to guess, I'm going for 1 point or 10 points or 5 points, because that'll never work. You have to take a profit based on the current conditions. Slower conditions, smaller profit. Larger conditions or more volatile conditions, a bigger profit. So if the market begins to break this 50% midpoint by a few points, you're long. Stop with limit, market, you're long. And the goal is for it to go all the way up to test the highs. Double tops, triple tops, you've probably heard of those words. It's very common that it'll try to get up there. Now I may miss it by a few ticks or a point, but it's still the attempt that I'm trying to capture. So even if the ATR may be 10 or 20 points, leading from here to here, this value here is from 60 to 205, roughly 45 points. You don't want to take the full 45, although you could with the trailing stop. I like to trail stops in certain ways, but 1 times the ATR, whether it's 10, 15, 20 points, is doable. So we want to do a trade that is actually possible. We don't want to have hopes that it's going to make it. We want to take a position that we know the likelihood of it being achieved is greater than normal. Okay, so let me give you some examples. So let me first take a look. Now this obviously is not the perfect example because we're not looking at 2016 being a January effect, but the idea is the same. You can see here that the market retraced back, and as it's coming back up to test new highs, it always has to make new highs in order for this to work. Once it comes back, you can see the attempt to test these highs. Now, I like to see an instant move. This is one of the things that you should look for as validation that it's happening. An instant move that it's just getting there and not flip-flopping, channeling, confused. We don't want to see that. We want to see a market that once it breaks by a few points, like it did here the previous day, that it's just going to go straight up. 5 days, 4 days, 6 days, it should give you the result that you want. In this case, you're looking at about 25, 26, 27 points. That's going to look something like that. It's 47 points. So I'm not suggesting that you go for the full 47 or 50 points leading you back up to the highs where it once was, but at least 1 times the ATR is doable. So I want you to look at the market as what can be achieved. This can be achieved. Anything else is considered gravy. Okay? Let me give you another example, and I'll actually go back. Let me see how many days I have here. Okay. Let me go actually back to actual years that had the January effect. 2008, 9, 10, 11, 12. We'll go back to here 2011. January began right here. And so I want to see the market when February runs around. It's higher. So on a monthly chart, it would look something like this, right? A higher close and open for January 2011. So what I want to do is wait until the market is clear that it's turning around, stopping, and then heading back up. And once the market moves a few points past the midpoint, as if it's coming back up to test those highs, this to me becomes the opportunity to go long. That's one of the ways I like to take a look and take advantage of the January effect. And I'll just keep this here. So we can just keep an eye on a few TradeScalper trades. I know you guys are interested in seeing some actual live signals, and I'll just keep that like that. So as the market starts to go higher and higher, you can see that there's a few days in February that retraces back. So again, remember, as soon as you see a clear retracement, as soon as it begins to break here, the highs, think about the ATR. Let me just bring the ATR back, indicating what really can I expect. 16 points is what I could expect, not 30 or 40 or 100, 16 points. So if you think about the amount of distance that exists to test those highs is 25 points. So 16, 17 should be no big deal. So as the market goes higher or lower from here to here, 18 points. All I wanted was 16 or 17 or 15, and the market moved to 19. So this ATR there, this ATR allows me to give a good target a chance to hit what I want to hit. Now in this case it did not test those highs or go and break through them, but still 1 times the ATR at least was possible, and that's what I want. Now if the market continues lower and lower, no problem. I have another opportunity because these highs have yet to be broken. Here it is again. It's breaking by a few points. This time, remember I spoke about the ATR being a cycle, slow periods, fast periods. Right now you're looking at about 27 points. That's a big target. So if I look at 27 points, at least to this value, the market should achieve, it should move to that price. That should be my target, and you should be out of the trade. Every time the market makes a new high, this occurs. Okay, so it's not as if from this point on I want to take another trade. I'd like to see it break the highs first and then give it to me again. 4 or 5 days of retracement followed by the market coming back to test those new highs. So remember, the January effect is not for us at least, it's not a hold strategy, because who wants to, withstand this amount of loss, right? It's a huge, huge loss. We can't really hold on to a trade like this. It's not feasible. But it's more likely that once it breaks the 50% mark, it's going to shoot to test those highs. You only want 1 times the ATR, which is pretty good. Questions on this? Safiso, Bob, Charles, Jerry, Karel, Rash, Tamer, everyone else? All right, now there's another way that I like to play this, okay? If the market breaks new highs, it's also an opportunity. Okay, so in addition, and let me, before I go any further, I'd like to have the Atlas line here up and running so we can actually take a look at it as it's happening. So give me a second, because I know that's something everyone wants to see. So I'll keep the Trade Scalper, and here is the Atlas line. Okay, right here. Okay, so the Atlas line has a short signal here at 22.0650. Again, this is based off of 2 consecutive candles closing. So everyone who has the Atlas line should have this signal 22.0650. Okay. Now I am going to place this trade as well. Give me just 1 second, bring up my dome here, and I am going to go short. 1 second, everyone. Let's get my dome in action here. 1 second. Okay. 22.0650 contracts and sell market. Okay. The ATR is 2 points. I have 2 points here, and I think that's doable. 22.0650. Testing these lows. There are 3 stops that I like to use. Okay. The stops that I like to use are a time, a proof, and a catastrophic. The catastrophic should never be more than 5 points, maximum of 2 times this value. The time-based stop is based off of 4 candles after entry. So if this chops around for 4 bars, which is 20 minutes, I'm out of the trade. If the market instead closes on the opposite side of the Atlas line, right here is the Atlas line, I have it as a hash, but you can actually have this set to a line instead if you wish. Okay, it could be a line as well. So hash, line, dots, dashes. So the Atlas line is here, this purple line right here. 22.0650 was the exact signal. And it's always based off price action. So I'm never looking to just jump in unless there's proof. It's 2 consecutive candles that close either above or below the Atlas line. The closing price is the entry. There's never a mistake. 22.0650, I got a tick better, which is great. And now if the market chops around for 4 candles, I'm out of the trade. If the market closes above the Atlas line, anywhere above here, it's considered proof. It's proof that I should be out of the trade or should no longer hold on to a position if there's proof that the market is not moving in my favor. So let's say that the market starts to rally and any candle closes, when the next 4 candles closes above, it's proof I should no longer hold on to the trade. So the stops are created to minimize the amount of loss that exists. If every trade was a catastrophic stop, that would never work. Instead, I want to use the catastrophic stop as the last resort, and instead maybe get a small target or a small loss with the other trade managements, which are time and proof. Okay. Tamer, questions? Raj, Karel, Jerry, Jack, everybody else, Bob. Now there's one last thing that I like to do as well. Again, this is all part of what I teach. It would be overbought, oversold. The distance that you're entering in relationship to the Atlas line is important. I never want to enter a trade considered overbought or oversold, meaning I'm late to this party. I'm entering into a market that has already made a big move up or a big move down. That is not something I want. I always want to make sure that this type of trade, it's called double bar short or double bar long, is actually closer to the Atlas line and not further away. Has nothing to do with pullback and strength trades, which you see here, P's indicating pulling back. That distance is different and is measured differently. It's measured from a pivotal point of view. But the actual first trade of the day, or if it crosses, this double bar long, double bar short, should always be as close as possible. So just to give you another example, here is this along 2206.75. This distance here is a 1.75. So we're not looking at a big move, but had this been, let's say, 5 points, 6 points away from the Atlas line, we're not taking the trade. It's too risky. It can be considered overbought. The same thing with, let me just go back to another day here, 2204.75. 1, 2, this is the entry based on closing price of bar number 2. This is only a 1.5. Again, not considered overbought, oversold. But if this entry, or any time that it crosses below the Atlas line, let's say we have a big move to the downside, before you enter, the same rules apply. Never want to enter more than two times the ATR up to maximum of 5 points. Okay? So as we see here, oops, I canceled that by accident, but the 2 points would be 2204.75. So we're looking at 7 ticks now. So what I like to do is, as far as trade management is concerned, I like to adjust this equal to the ATR. Trade management incorporates, if the market slows down, I'd like to adjust my target. If the market speeds up, I leave everything the same. So the ATR is indicating a slower environment here because it started off with 2 points. Now it's only 7. I adjust my target, always based on the current conditions, 7 ticks. Now, if this candle closes and the ATR goes down to 6 ticks, I adjust my profit again to 6 ticks. But if it goes up to 2 points, I leave everything the same, okay? So we're always decreasing and being more conservative when it comes to a target if the market slows down, never increasing if it begins to speed up. Let's say some news event occurs and the market begins to become very volatile. I'm not increasing my target because it could actually be going in the opposite direction. That doesn't really help. Is everybody on the same page? Am I going too fast? Sometimes it's a little difficult to trade live and explain everything that's going on. Safiso, I know you have the Atlas line. Do you have any questions for me? All right, thanks, Karel. All right, now again, remember, the stops, I like to use black and white type of teaching, which is never subjective. It's still the time, 4 candles. It's still 2 times the ATR, maximum of 5 points, or prove it stop, any candle closing on the opposite side. So those never change. Okay, they are always the same. The one thing that I do recommend, though, is, again, before you enter, is it overbought or oversold? Yes or no? If it is, skip the trade completely, look for something better. Is the market slowing down while you're in a trade? I can understand if it's happening because the ATR gets smaller and smaller and smaller, and the targets are adjusted accordingly, okay, accordingly. But if they increase, I don't increase my target. I keep everything exactly the same. Now, it's being recorded. Yes, Karel, it is. I try to record everything, even all the classes that I do, whether it be the Atlas Line training, the mentorship, I record everything. So in the event that you want to review, then ask questions, send me an email. I try to provide everyone with the recordings of all the trainings. Okay, and that's for everything that I show and I teach. One last thing here is news. When news occurs, you have to be very careful because this is an unpredictable factor that impacts the market. Sure, the market could go in your favor very fast and very strong, but it could also go against you. We don't know. We're on the outside. If the market does go ballistic, there's so many things that could happen during this news event that I much rather prefer to completely wait it out. Usually 2 candles is enough time for everything to get back to normal, and then you can enter. So if you ever are about to take a trade, and whether it's the news indicator that I offer for free, which is here, you can anyone can download it if you want. It's the news indicator. Let me see if I have it here. Yep. So I provide this indicator free of charge. It's in the, it's right there. It tells me the dates and whether it's high or low priority. It gives international news as well. Something that you should be aware of. It's a live actual indicator on your chart. And Bloomberg has a good, on my calendar, Forex Factory. There's a ton of them out there. Just look at the news, make sure that there's not something happening right as you're entering long or short, because it could just blow right through your stop, and that's not what we want. We don't want to be in this unpredictable environment. Okay. All right. So far, this would be considered 1 for the time-based stop. That is right. This would be considered 2. This would be considered 3. And the fourth candle, when it does close, I'm out of the trade. Win, lose, or draw. Could be a small winner, could be a small loss, could be a break-even trade. We could get the target before that. I'm managing the trade. I'm not holding on to a position if it's just chopping around. I want to see an instant gratification based on why I'm going short or why I'm going long. Now that is the Atlas line, and I'm just going to put this here to one side. I'm going to just put away the daily chart. I'm going to put this over here, and we'll take a look here at the Trade Scalper as well. So I'm just going to stick this dome right here. So the Trade Scalper is a breakout strategy. It's looking for an opportunity to go long or to go short. It works on every market. Here is an example of a euro. So here is a euro giving you a long earlier, but it does not give you a signal if the market's chopping around, like you see here, how it's just flip-flopping around. It won't give you a signal if the market's chopping around. It needs to show a clear breaking out pattern that it's going somewhere and heading somewhere, and you take advantage of it. Now, one thing about the Trade Scalper, and the problem that a lot of breakout strategies have, is that a breakout occurs and you enter. But the relationship between the market breaking out and continuing and where you enter is a big deal, okay? So as a reference, never, as far as your own breakout strategies, if you're doing your own breakout type of moves, instead of taking a trade where you're jumping in because it penetrated a certain number or value or high, always wait for a better price. You're much better at getting in at a better price after the breakout has occurred, if it gives it to you, and leading you into an area where it's already been. So in my opinion, breakout strategies, even though they sound great, they look great on paper, they have a fault. The fault being you're always going into the unknown. So if you take a look here at the E-mini on the Trade Scalper, or even the euro here on the Trade Scalper, if I was going to go long here, what's for me to know if it's going to continue? I don't know if it's going to continue. We're going into the unknown. But if I realize the market's breaking out higher and I get in at a better price to test where it's already been, the likelihood of the market getting there and the trade actually being a higher percentage of accuracy works in your favor. So just as a reference, as a frame of thought, breakout strategies typically lead you into the unknown where you're hoping it's going to continue to make 2, 3 ticks, 5 ticks, whatever the case may be. Realize first that it broke out, enter at a better price to test where it's already been. To me, that's a much better example. Okay. So if you want to see, we'll see if there's a Trade Scalper trade here anytime soon. If the market needs to actually move and go somewhere or do something. To take a look at a few examples, pre-market, a couple of short trades, a couple of long trades, but this ATR, once again, is very important. Trading for one tick, in my opinion, not worth it. Minimum of 2 ticks on any market, my recommendation. Minimum of 3 ticks if you really want to see normal movement. So whenever the market is below here, 2 ticks, it's really not worth trading. And as an example, if you take a look at the TradeScalper properties, one of the settings here is a filter. And the filter basically says if the market is less than 2 ticks or less than 3 ticks, so 0.5 is half a point or 2 ticks on the E-mini. But whatever market you're looking at, stocks or currencies, you can actually say, I don't want to see any trade less than 2 ticks or 3 ticks or 4 ticks or whatever the case may be. Personally, 2 ticks is the minimum I like to see. And this filter is built in, and you set it whatever you want. So anything less than 2 ticks, I would say to you personally, forget about it. Okay? So you see how there's much more chop that happens under slower conditions, and that's true whether it's a 1-minute chart or 5-minute chart. It's just relative. So less than 2 ticks, this is the chop. Now let me show you an example of when the market's a little bit more active, and even though this may be considered here pre-market, it's 2 ticks or more, and when it's 2 ticks or more, take a look at the jump that happens. It's much more likely that you're going to see a move under more normal, at least 2 or 3 ticks, instead of chopping around at 1 tick, just gapping and wicks and things like that. So here is, let me show you here, this is probably the Thanksgiving holiday, and now we have a situation where it happens to be a little bit more active. 2 ticks, 3 ticks. The difference is very noticeable as compared to the price action being a big chop mess when it's less than 2 ticks. So again, as a reference point, you can't trade when the market is slow because it doesn't go anywhere, do anything, it chops around and stops you out. Instead, if the conditions are more active, I can understand they are, and then I can take a trade. Now on this 4th candle, bar number 4, if this, at the close of this candle, which actually I should put the bar timer. Something I like to add is the bar timer. Okay, in about a minute, this is going nowhere. I'm out of the trade. I don't like to have losing trades, so within the last 20, 30 seconds, break even, 1 tick profit, 2 ticks profit. It almost made the target, but in trading, as you know, almost never counts. Okay, so within the last minute or so, I'm going to exit this position. If you are short, I would recommend you do the same thing. Break even, 1 tick loss, 1 tick winner, it's fine. But by all means, at the end of this current minute, which will end this 5-minute candle, out of the trade. Everybody okay with that? Just want to give you a reference point on what to do next. Okay. And again, with the Trade Scalper, there's no signal here. Market is chopping around. So far, and as soon as this trade is over, I will get back to January effect, because I do want to provide you an opportunity as the new year begins, that you're going to see these opportunities to buy the market if it's true, the January effect. Now, we may not have a January effect, and the markets may still go up, and it doesn't mean the opposite, so don't think because the market did not go. Okay, so I'm out of this position, so let me just bring up my dome again. Here, I'm just going to close it out. Okay, so really a break-even trade, and that's the way it goes. And that's good. That's okay. I don't want to lose money. It's okay to lose a tick or two. I want to go for 1 times the ATR in every trade and give it a chance. Charles, you have any question? Tamer, Karel, Jerry, everybody else? Rebecca? Julie? Okay, now the next trade, there's a couple of P's in these S's. I didn't really explain this here. These are called pullback and strength trades. So that's what this happens to be here. Pullback and strength trades. These are additional trades that the Atlas line produces. they are based off of patterns. You can use it on TradeStation Corel, yes. TradeStation, eSignal. And for those of you who have a lifetime license, there's a few of you here. For the Atlas line, I never charge for an upgrade. NinjaTrader 8 just came out. It was in beta mode for some time. I want to make sure that there's no problems. There's no quick updates. And what I want to do is provide everyone the NinjaTrader 8 version of the Atlas line. Since you're a lifetime license holder, I do not charge anything. So I'm continuing to support you guys, even if you've purchased it maybe 3, 4 years ago, 5 years ago. So pullback and strength trades are additional opportunities. What are they? Well, if the market pulls back, I have an opportunity to take a trade. If the market shows strength, I have an opportunity to take a trade. The pullback and strength trades are good opportunities, especially during trending markets. I only like to take a point on these pullback and strength trades. So what you see here, these P's and these S's, which are right here. I'm not going to remove the news indicator. I just wanted to show you if that's something that you're interested in downloading. You can download it for free. The P's and the S's indicate pulling back feature and strength trade feature. They're only good for a point. Now, it could go more than a point, obviously, but I only want to take a point on the strength and pullback trades. In addition, because the market's below the Atlas line, it's only short trades. If the market crosses the Atlas line, it will be only long trades, and that's for pullback and strength trades, as well as the other signals the Atlas line produces: bounce, double bar long, double bar short. So for example, while I wait for a TradeScalper signal or another Atlas line signal, let me go back here and show you how, even though it's a holiday, slower than normal, if the market's in a trend, it does provide you additional pullback and strength trades. So forget for a moment that this is Thanksgiving or Good Friday. If the pattern and the opportunity exists, these will provide you more long trades. So this starts it off. This continues more long opportunities. So only long trades above the Atlas line, only short trades below the Atlas line. And that works well if you're using the Trade Scalper. You only want to take long trades. As a filter or as a backup, you can say, I should only take long trades because price is above the Atlas line. And you can use the Atlas line on a 5-minute chart, which I recommend, or even a 1-minute chart as well. Same thing with here. It's only short trades. It's only long trades. And then you see additional long trades, strength, and pullbacks. Okay, Charles, you said there were lots of information. I have time. Do you have any specific questions I can help you with? All right, Jeremy. For the mentorship class, this is all included. So you don't have to purchase the Atlas line or the Trade Scalper separately. The mentorship is all inclusive. So it includes the Atlas line, the training, the Trade Scalper, and everything else. So it's not additional that you have to purchase anything. Everything is a lifetime license. Same thing here. Here's the short, here is the long. Only short trades, only long trades. And you can see, let me just push that away here, strengths and pullback. Pullback and strengths. All right, Jeremy, you got it? Put this here to the side, and market's not really doing anything. I'm going to put up here the euro as just to give you another demonstration of the Trade Scalper in action. Trade Scalper on the euro is giving me a little bit more, a few more examples of orders and entries and signals. Since the E-mini is a little on the slower side, we're now at 2 ticks. You're not going to see many signals unless it picks up, unless it starts going somewhere, moving somewhere, and taking off. The 2 signals are the double wick and the basic long and short. Okay. I'm going to get back to, while we wait for signals to appear, maybe I'll take another trade maybe on the scalper or the Atlas line. So I have to keep an eye on it. For the daily chart of the January effect, let me just get back to that daily chart. I'll just keep an eye on what's happening here. I'll give you another example. The 2 examples of ways to take advantage of it. Let me go here to 2012. January higher close and open, so it's definitely an up month, something like this. As you go forward, wait for the market 3, 4, 5 days, 6 days, and then heading back. This I would not count. I don't think it is significant enough. It has to be more telling. This is more telling. And the market again came back to test those highs. It did it a second time. But if you're going to notice something, from here to here, if you're looking at going long, it never provided you a signal back above the 50% mark. That is something that we should understand, because if this does not provide a signal, you don't get in. It goes lower, adjust it. Now it broke it by a few points. I'm long. This is the opportunity. 17 points, 17 points, 64 points, 33. So if I just wanted 17, or I'm sorry, it's actually 18 points, then 18 points is your target. So I'm not suggesting I know that it's going to just rocket and keep on going, but it made the target. Now it has to get up to here or break it for another opportunity. It broke it. Here is where I like to take advantage of another type of move on this January effect. If it breaks the high, the likelihood of it going higher exists, especially in years with the January effect. So a few points above the high, I understand you're going into the unknown. It's definitely a little riskier. You can go long once it makes and breaks all-time highs. So if you can have a stop with limit, you can go off to work and have a stop never more than 2 times this value. In this case, 10 points would be 20 points. I know it's a lot. That's the kind of stop you have to have in order to trade on the daily chart. You have to have a stop large enough to keep you in the market. So once it breaks the all-time highs, expect it to rally. You got it, Carell. Will do. No problem. And I'm just about to wrap up here because I have a someone I have to start a class with, private mentorship student. So we're starting briefly, so I have to also go here in a few minutes. But as soon as it breaks a few points above the all-time highs, expect the market to rally at least 1 times the ATR. Now again, look, the market is retracing back 3, 4, 5 days. What does it do? In this case, it's a little bit smaller, the market. Broke here by a few points. And what does it do? 18 points. What's the target based on your entry? Even if it's 15, even if I round up, it's still doable. The market still went 18. You just wanted 14, 15. So always have a specific target based on the current conditions. That's too bad. Now the market is actually moving lower, even with all the Cyber Monday and Black Friday talk. Price is below the Atlas line, and it's staying there. It's short until it either crosses above or a different signal appears. Nice, big, huge pullback, which is nice to see. Continues, and by the way, just put this here. Okay, broke it, 13 points, no problem. It actually went 41 points. And look again at this other option, which I think is riskier, but it's just an option if you want to take it. Once it breaks the highs made for the year, remember, January effect only provides this opportunity. Breaks it, expect the market to just rally very strong and very fast. All of these moves should occur in a short amount of time, not 30 days later. You see, it just kept on going. 1, 2, 3, 4, 5, 6 days. 4, 5 really is the minimum. Again, why not take advantage of it? And you can see once it broke the highs, again, rally big. 1, 2, 3, 4, 5. 5 days. Here's the high, broke it, rallied. Once again, a little advantage here to take it from there to there. Not rocket science, doesn't have to be complicated. I think it just has to make, I think, a little bit more sense than anything. To print over the bars here, Jerry, do you have the Atlas line? Jerry, I can show it to you. If you move it out of the way by just holding it and pushing it out of the way, you can see that it doesn't clutter your chart. If you instead say, I want to see the market giving me the signals, bars back, let's say 10 bars back, it doesn't change where you enter, it just moves it out of the way, right, as you know. So you can have this 10 bars back, 30 bars back, but it's still the same signal, the same candle, and so on. The last thing that you could do is click either the candles or click the indicator, either the indicator or the candles themselves. Hold down the shift key, I believe, and scroll the mouse wheel. And when you scroll the mouse wheel, you see how it says level 15, 13, 12, 10, 3. Okay, so you don't have all these levels and drawing tools. It's just really one or the other. And what that does, it prints on top. The candles are printing on top of the indicator. If I do that again, it prints now the opposite. The indicator is printing on top of the candles. So there's a couple ways you can do it. You can offset the text so it doesn't clutter your charts. You can do this navigation and then the levels, or the indicator and the levels. You're welcome. So I wanted to show you the Atlas line. I wanted to show you the Trade Scalper. I wanted to go over a little bit of this January effect. And, oh, double wick short here in the E-mini. Okay, so here is a signal on the, I didn't even see it as it happened. Okay, so let's take this signal here. Double wick short, you can see here it's 2 consecutive wicks. 22.05 quarter is the entry. How many ticks profit would I expect this market to make? Who knows here? 2, right? 2 ticks, right? Not 3 ticks, not 5 ticks, not 30 ticks. The 1 times the ATR tells me that currently the market is capable of sustaining 2 ticks. Okay, so 2 ticks as I go forward in time leads me from 22.05 quarter to 22.0475. That's exactly what the market did. Now, as soon as it hits this, you want to take your profit and run. It doesn't always fill you. So if you are not filled, and this happens because we use limit orders, if you're not filled, if it touches your target, it doesn't go through it by a tick, I want you to force yourself out. I don't want you to lose money on this trade. If it comes back to where you entered, you get out of the trade. The same thing with the Atlas line. If I had that target touch but not fill and it comes back to where I entered, that's it. That may have been the only attempt to make that move, and I'm cutting it loose. I do not want a losing trade. Okay? Now here's a long 22.07. I'm not sure if you would have been filled here because it may have happened pretty quickly. And the same thing on the euro. Here is 106 for the long. You may get a short coming around as well. Here, possibly. Okay, Jerry, any questions for me while you have me? Tamer, everybody else? Rebecca, Jeremy, Jessica? Okay, very good. So for those of you who are attending the mentorship class beginning this afternoon, I'll see everybody later. Get ready. We're going to spend the next 8 weeks together. I'm glad you guys could join the webinar this morning. This is just a quick preview of what you're going to see, expect. As most of you have already. We've already provided you the software. If anybody's still interested in joining up, just send me an email. I'll be available by email if you need to contact me for anything discussed here in this webinar. All right. You got it. Thank you, everyone. Any final questions before I close out the room? The stop is relative, Tamer. So if you are looking at a large stop will only occur if the market's very volatile. It's relative. You don't have to risk a lot if the market's slow. You do have to risk a little bit more when the market is more volatile. But if it is more volatile, you have to update the target and update the stop at the same time. So for example, this trade right here on the euro, it's a double wick short. You probably saw it live, 1.0597 short. The ATR is 3 ticks. I will not risk more than 6 ticks on this trade. So it's relative to the current conditions. 6 ticks. Let me see here. 1, 2, 3, 4. So this already made, based on the target, the 3 ticks, because it went already 5 or 6 ticks already. So this is just giving off short signals left and right here. But essentially, this being 3 ticks, 6 ticks stop maximum. That's for scalping. Now for the Atlas line, it's a little bit different because the Atlas line works in points, or I should say, it works in larger denominations, not really scalping. So if the ATR is 3 points, maximum of 5. If the ATR is 4 points, maximum of 5. So it's not doubling the ATR incrementally, just keeping on doubling it and doubling it. It's always a maximum of 5 points regardless. Temer. The ATR. Are you familiar with the ATR? There's a lot of videos that I put out on the ATR. Tamer, if you want, email me. I can send you a few beginner videos on what the ATR is, how I use it. Average true range, actually. That's the ATR short for it. And just send me an email. I'm happy to explain it to you, or send you videos that explain it that I've done in the past. All right, Safiso, any questions for me? Safiso? All right. Email me if you need me, okay? Have a great rest of your day. Stay safe, everyone. Bye-bye now. Thank you. Thanks, Jack. Bye-bye now. Thanks, everybody.